This video covers pages 5.20 through 5.38 of Chapter 5 of the CPCU Insurance Operations text. We skip over risk control for this course because most of the risk control portion of this chapter is covered in the Business Risk Management class, or ARMIN 3008. So for this video lecture, we'll focus on premium auditing. First, let's look at the reasons for premium auditing. Simply put, premium auditing can be defined as examining an insured's books to determine the actual exposure covered by premium that has already been charged. With any type of insurance, the amount of premium charged is based on exposure units. Remember that premium for an insurance policy equals the rate times the number of exposure units. Premium auditing is especially important when the exposure units are not stable or when they fluctuate. For example, with workers' compensation, the unit of exposure for workers' compensation is $100 of payroll. In other words, the premium is the rate times each $100 of payroll. For commercial auto, the premiums are based on the number of vehicles, or the rate times the number of vehicles insured. And for general liability, premiums are based on $1,000 of sales or $1,000 of payroll. So an audit is done primarily to make sure that the premium is adequate when exposures change. In other words, that the insurer is charging enough when the premium is adjustable based on changes in the underlying exposure units. So, an audit must be done to determine the correct premium, but also to collect loss data for future rate-making calculations. This is a quick look at a loss triangle, which is how data, both premium and loss data, in this case it's loss data, is commonly arranged in order to determine future rates for a specific line of business. Also, an audit is done to meet regulatory requirements. This is especially true for workers' compensation. Most states' Department of Labor or Department of Employment and Labor monitors whether or not employers in the state are meeting workers' compensation requirements by purchasing insurance to cover their employees. The audits are especially useful to detect and deter fraud. Workers' compensation systems are known to be fraught with fraudulent activity, both in terms of workers making illegitimate claims and employers not purchasing insurance under the state's requirements. Also, an audit is done to reinforce the insured's confidence, to make the insured certain that the premium that they're paying is accurate, not only in that it's not too much, but also to ensure that the premium is adequate and will cover the insured's total exposure. And last, an audit can sometimes be useful in obtaining additional information about the insured, such as when a hazard changes or new exposures arise. For example, if employers hire new workers in a position that could be classified as higher hazard than past employees. Now let's look at the premium auditing process. Premium auditing entails reviewing the operations of the insured, determining the employment relationships, finding and evaluating their books, and auditing those books and records, and reporting the data. But the first step is always, as with any process, to plan. An insurer first must decide which insureds do we need to audit. Auditing an insured is very expensive. It's unrealistic that an insurer would audit all of its insureds. Insureds whose exposure fluctuates greatly, have complex operations, or possibly have red flags indicating that there might be problems, are obviously more likely to be chosen for an audit. So after making the plan, the next step is to review operations of the insured. This helps identify changes in any exposures. It's actually quite common for the insured not to reveal changes, not necessarily on purpose, either because of not knowing that this is necessary or simply not having time. The Insurance Services Office, PAAS, or Premium Audit Advising Service, and the NCCI, National Council on Compensation Insurance, can help insurers in working with their insureds to identify changes in exposures. Next, the insurance company must determine employment relationships between the insured and their employees. This is true when premiums are based on payroll, always with workers' compensation, and sometimes with general liability, which might be based on sales. There should be a specified definition of covered employee. In workers' compensation, this is statutory. In other words, it's based on state law. So the insurer must ask, what does the state law say about who a covered employee should be? There are different requirements for an employee versus an independent contractor and a subcontractor. Although in some states there are exceptions, employees must always be covered under workers' compensation, but an independent contractor or subcontractor generally only needs to be covered if they do not produce a certificate of insurance. And then there must be a determination about whether sole proprietors and officers of the company should be insured under the workers' compensation. Some states do require sole proprietors and officers to be covered under work comp laws. Next, finding and evaluating the books. Employers' quality of record keeping varies. One of the problematic areas is to distinguish between overtime and regular pay. Since overtime pay is generally higher, it shouldn't be classified the same way as regular pay in terms of exposure. Bonuses and commissions are typically included in the calculation of payroll, but severance pay is generally not included. Once you've found and begun to evaluate the books and records, they must now be audited. This includes making sure the classification was right from the beginning. Industries with different hazards and different employee classifications will pay different rates. For example, with trucking, trucks hauling hazardous materials will pay a higher rate than trucks hauling non-hazardous materials. The data must be analyzed and verified. An insurance premium auditor must ask, does the data make sense? This might require an investigation. Insurance professionals of all types often have to ask, does this make sense? For example, if you get a report for 30,000 units of payroll for 30 workers, and a unit of payroll is $100, you have $3 million of payroll for 30 workers, which equals $100,000 per worker. However, if the report says that the workers are all grocery cashiers or receptionists, this should be a red flag. This says the data doesn't make sense and it requires further investigation. In the insurance world, data reporting accuracy is critical. If data is not reported accurately, insurance premiums can be inadequate, which could hurt both the insurer and the insured. Next, the data must be reported to underwriters and other appropriate personnel, including, in some cases, the insured. So let's end with the importance of premium auditing. First, to the insured, and then to the insurer. To the insured, it ensures that each insured pays their fair share. Honest, organized, and lower risk insureds should not have to pay for excessive losses of other insureds. If the underlying exposures were not audited, then insureds who didn't accurately report their exposure would get away with it, and this would cause the losses of the whole pool to be higher than they should be. Honest and lower risk insureds would end up having to pay more than their fair share of losses. And it's important to the insurer because misclassifying hazardous businesses makes premiums inadequate, and misclassifying safer businesses means that a policyholder will take their business to another insurer. And that's the end of our discussion of premium auditing.